Let's also discuss how we can measure information asymmetry and apply additional technique to understand whether this particular conception of capital structure holds. What could be the proxies for information asymmetry once again? Many researchers, to understand whether pecking order holds, will apply so-called event studies. What is an event? We can say that if the company is announcing the equity issue, this is really very important, really very sound event. And then the market, the investors, they should react. So depending on the perception of the investors about the perspectives of the company, the reaction could be positive or it could be negative. Next, how we can approximate the level of information asymmetry if we want to compare different companies in the sample when we are applying event studies. And we would like to understand whether the reaction of investors could be different for similar events about the equity issues, depending on the level of information asymmetry. I already mentioned that in papers, when you need to understand the information asymmetry, how much is this asymmetry, or maybe it's not as big as we can think about it, we at first will look at some analytical agencies, those who follow the company. We then will look what they are producing as analytical products. Do they have really dispersion in their estimates between the analytical agencies for the same particular company? The higher the volatility in their forecasts, in their judgments about the company, the higher the information asymmetry, because those are analytics. They are carefully collecting all the news, all the data. They are carefully watching for the business. But something is wrong with this information. It's not purely consistent. So that's why the forecasts can really differ, and there could be high volatility in the profits they are forecasting for some future. Then we can collect the sample according to these particular indicators, these proxies of information asymmetry, trying to maybe divide it into two subsamples, saying those companies they really have high level of information asymmetry. The residual part of the sample may have lower level of information asymmetry, so on and so forth. Next step, then the researcher should compute so-called normal rates of return with the specific models of asset pricing. Again, those of you who will join us in degree program, you will go with us through the specific course which will show how it works in research, how we can apply it for some new data of your countries you are interested in. But now I'm not going into technical details. If you've got that normal expected rate of return for all the companies in your sample, now the logical step would be, let's compare the actual rates of return on the stock of the companies included into the sample with this normal rate of return. I'm not discussing particular ways how you are going to compute the normal rates of return. There are few of them, but in any case, you will get your normal rate of return. And then comparing it to the actual rate of return, you will compute these deviations of the prices from the normal rates of return within some period of time. Then if you summarize, if you add them up, all these deviations, you will get so-called cumulative abnormal return. Why it's called abnormal? Because you are comparing the actual to the normal one. It could be higher or it could be lower than normal rate of return. In both cases, it would be called abnormal because it's not strictly equal to the normal rate of return. Imagine if you are an investor and you do think that that stock issue is something really positive for the company, you don't think this is adverse selection of the managers, you don't think that the stock issue is a type of a lemon but not a sweet fruit, then your reaction would be positive. And this cumulative abnormal returns, the changes, the deviations summarized for the period, will be above zero. But on the contrary, if you do think the managers, they announce this additional equity issue just at period when stock is already overpriced, then this is adverse selection argument behind the decision of the management team. This is a lemon, but not a sweet fruit. So then the reaction is going to be negative of the investors, and the cumulative abnormal returns may become below zero or negative. So that particular approach, which is called event studies, it's really important to compute cumulative abnormal returns and then try to understand the overall reaction, positive or negative. Continuing the technique, then it would be applied to a particular sample, and you need to understand whether these abnormal returns are really statistically significant. Again, I'm not going into technical details, but what we would like to discuss better. At first, we need to understand that when researchers are focused on the so-called short-term reaction or almost immediate reaction for a few days after the announcement, after the event, on average, all these reactions are in most cases negative. And it will mean that investors think the announcement arrived at the market when the current market prices per shares of this particular firm were already or above the true or fundamental value. But if we try to differentiate between companies with higher growth opportunities and companies with lower growth opportunities, then we will apply the coefficient which is called market-to-book ratio. In the first lecture devoted to the capital structure decision, I explained you this is a type of a determinant market-to-book ratio, which is a proxy for the growth opportunity. So, and in many papers, researchers will come to the conclusion that almost no negative reaction at the announcement day will follow the announcement about the equity issues if the company has higher than average growth opportunities. On the contrary, if the company has lower than average growth opportunities, the negative reaction will happen, and it could be really, really strong. Next very important point in the papers which are focused on the immediate or short-term reaction of investors. If the negative reaction occurs, then it means the investors are not willing to buy that stock at that particular current price. They would like the discounts to the market price. And the level of discounts will become even bigger. The discounts will increase after several days after the announcement, after the event arrived to the market. So many researchers will conclude investors really thought stock were overvalued. It was a lemon, and it was adverse selection motivation behind the decisions of management teams. Next, also very interesting, if we compare the reaction after the announcement for all types of securities of some particular companies, including debt securities and, of course, equity of different types, then we can understand that there is a different reaction to different issues. So, the first, it's really very important when we are talking about the common stock issue, the reaction would be first negative, and second, it would be really strongly negative. It would be significant. It would have very low, very high, discounts from the market price. It will mean that investors again think that the company is already overpriced and managers want them to buy that lemon. And analysts will think that analysts which are following that particular firm, they may think that if managers made a decision just at that period of time to make that particular announcement and to go into the new equity issue, maybe those managers, because they have private information, are not very much optimistic about the perspectives of the upside trend to the market price. So they already think the stock is overpriced, because remember, if the stock is overpriced, then the expected rate of return is lower, then the cost of equity financing is lower as compared to the opposite situation when the stock is underpriced. So the first argument, managers would like, of course, lower cost of financing. And it happens if the stock is overpriced. But if they think the price even can become higher than now, then maybe they have to wait. But if they didn't wait and they announced just now the new equity issue, they are not very optimistic about the future perspective to upside in the stock price. Again, these particular observations in empirical research are consistent with the adverse selection problem. Next. We already talked about common equity issues, and we already said there is a negative reaction of investors. But what is also interesting, there is a relationship between the amount of equity issue, about the sum of money the company is announcing, and the negative reaction and the quality of that negative reaction, I would say. So the larger the equity issue which is announced, the more negative is this effect on the investor side. Next, how about the debt issues? How about the reaction of investors for the prices of debt securities? In case the company is issuing straight or traditional or just standard debt in terms of, let's say, corporate bonds, it would be the least negative reaction, if any. Many researchers will even not find any negative reaction. In case the company is issuing so-called convertible debt or convertible bonds, which has already built-in equity-like component, because at some period in time it would be converted into a company's common stock, voting stock, again there could be negative reaction observed of investors. And finally, what we would like to conclude here, again, if we are looking through the papers which are trying to compare the level of the negative reaction after the event, after the announcement, how the company is going to finance the business according to this logic of pecking order of financing, we see different reaction, mostly negative for equity in all cases, mostly non-negative in the case of debt securities, which mean that, again, adverse selection motivation is behind the decisions of managers. To summarize, the higher the asymmetry of information, the deeper is the decrease in the stock prices. In case of high growth opportunities, the reaction of the market is going to be much smoother. It's not as huge. And the weaker reaction of the investors will come in case if we are looking at the companies which are now at their growth stage of the life cycles. But again, we would like to conclude that the reaction is based on the information asymmetry. Information asymmetry is generating the motivation which is titled adverse selection problem or adverse selection argument of management team.